Stocks bounced pretty nicely on this trade news over the weekend. Is the worst behind us now? What should we expect to see from the next high point that we get? And how does that impact our market posture going forward, our expected market posture going forward? I'm going to break that down in tonight's video. I'm also going to continue to talk about this sector rotation going on, the ramification, consequences of this rotation, what's moving in the different asset classes, with a trade idea today, and how we can take advantage with our market posture and our sector rotation working together. All right, today is Monday, October the 1st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Click the Market Scholars logo right there in the bottom right corner of your video, and then click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me two things. You like tonight's video, number one, and number two, you're telling us to keep doing these videos day after day. It's a really easy way to give us feedback. Also comment on anything that stands out to you from tonight's video. You can do that further below. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your video. Click that link. A really easy way to subscribe. Also follow me on Twitter for more content like this throughout the day. And you can join our Market Outlook community on Facebook. All right, let's take a look at the S&P 500 first off with the market forecast indicator. We did close today. It's starting really bullish on that NAFTA news over the weekend. We did close up above Friday's high, which Friday produced the bearish posture. Didn't last very long as we jumped right back up. Not quite up above 80 by the end of the day. You can kind of see we were flirting so close to it though that the actual figure here does produce a green shading. And kind of we were kind of going back and forth. We'll see if that holds. Technically being below 80, or no, excuse me, it turned up. It was higher, so that's why we're green as that turned up. Again, getting above 80 will keep it green no matter which way it's going, up, down, or sideways, as you can see here. So maintaining this bullish posture now that we're going on 3 months, right? Because remember, it started back here at the beginning of October is when the intermediate line, July. So now we're going on 3 months here of this bullish posture, starting a new bullish near-term run with the near-term line coming up. Now keep in mind, we've talked about the signs, the near-term signs. Now remember, a bearish posture like this does not start unless you get a bearish near-term low point or a bearish near-term high. So here's a bearish near-term high, a lower high compared to the last near-term high, with the near-term line not getting above 80. So that's a bearish near-term high, almost a bearish near-term low. We got a smidgen below 20, but it doesn't start unless you get one or the other. It has to have one or the other. You can see before that, we never did have a bearish near-term high or low. We just continued higher. So we haven't been getting that. Now we've been getting, signs, right? Short, bullish, near-term runs. The bearish divergence that we saw here with the lower highs and the higher highs. The extended bearish or extended pullback on the near-term line that lasted more than the typical 1 to 3 days. Even though it didn't get below 20, this one did get below 20 and is also an extended near-term run, but it's not a bearish low because we're not falling to a lower low point yet. Compared to the last near-term low. So, while, again, a bearish posture does not start without a bearish near-term high or a bearish near-term low point, lower low on the chart that corresponds to a drop below 20 on that line. So, but we are definitely getting more and more signs of weakness. And again, this bounce that we're getting, that's this bounce that was today, right? That we got a good bounce today. It didn't finish very strong, but we started off with a pretty decent bounce. We were always going to bounce back up on the near-term line, right? It doesn't stay down forever. It does bounce back up. The question is, where and how is it going to bounce back up? Is it going to bounce back up above 80, get up here, and we break up the new highs? The trend continues, right? Is it going to stall out without getting up there, or is it going to get up to a slightly higher high, but not get above 80 here before it rolls over and produce another sign of weakness with a greater potential of a drop to a lower low? that's what we're watching for. Until then, again, bullish posture because we're green. Bullish posture, the trend still continues. And again, this has been a nice orderly run. This has not been like the one that we saw over here, where we saw near-term runs that were like 20 days long. That was too much. Now we're on the other end of the spectrum where the near-term runs are not long enough, but at least they're continuing with higher highs and higher lows. When we don't get one of those is when we really have to worry about it, and we haven't yet. So we're continuing to bounce, and now we're watching to see where's that next near-term high going to get to, and where's that blue line going to get to on the market forecast down below. If you take a look at the Dow Jones Industrial Average, so we are above 80, strong bullish posture still, but we are back up above 80, coming off this low. Again, this was not a bearish near-term low point. It was a higher near-term low, even though we did drop below 20. So now where's the next near-term high going to be? Is it going to be a lower high with a rollover from here? We wouldn't expect that yet because we don't have a bearish posture yet. But once we do get that, now the expectations start to change. Again, you can see the NASDAQ composite. This one is a little bit more bearish. You can see this is, did not get above 80 here. In fact, the last one before that barely did get above 80, and it was a lower high. This one's actually a slightly higher high, a little bit higher. But again, you see how we're not getting above 80. Signs of weakness, even if we're not necessarily getting lower lows yet on the near-term line. And then finally, the Russell 2000. This one has been the most bearish. It is below 50. You can see a much bigger drop today on the Russell 2000. Near-term line dropping, getting bearish near-term lows, getting bearish near-term highs. So the Russell has been showing what we haven't yet seen on the other indexes. So again, the expectations, even though the postures are still strongly bullish on all these other indexes, we would expect, except for the NASDAQ. The NASDAQ's not as strongly bullish. It's still bullish, not above 80 or close to it. But the Russell is showing there's a good chance that the others might follow suit, right? Again, it did over here in July. So we had the end of June, beginning of July, that bearish posture. And you can see that's about the same time all the other indexes showed the same bearishness. End of June, beginning of July. Before we look at some other charts, I did want to remind you that you can watch our video here on our blog on marketscholars.com. Again, click on blog at the top of the screen and find the market outlook for tonight. I remember we were looking for 3 clicks. We asked for 3 clicks to tell us that you want us to keep doing these videos day in and day out. One is to click this heart right here on tonight's market outlook tweet, and then click on that like button. And the second is to click this image. That will take you to your Facebook page where you can like tonight's Market Outlook post on Facebook. And the third one would be to like it right here. Remember, you can chat or ask questions or comment on anything in the videos in the Market Outlook forums. You have to subscribe to our site to do that. You can do that for free. Just click this image, and that will take you to our page where you can subscribe to our site. And then you can click this link to get to the Market Outlook forums. Alright, if you take a look at the long-term chart, you can see the bodies and the size of each candle is continuing to get smaller and smaller, but we are still above a rising 50-day moving average, which is still above a rising 200-day moving average. The gap between the two continues to rise according to the MACD down here. It's all bullish from a long-term perspective. So again, it doesn't mean that we have to keep going up, but it doesn't mean we can't go down, but it does mean that we're probably not going to fall off a cliff unless we get extreme, right? Like we did right here, where we just got so extreme as we saw. We are pretty strongly bullish. It's not too often that we're this high, so that keep that in mind. We are well up above that 200-day moving average. At worst, at worst we could start looking for. Well, at worst we could tank, right? But at best, we're probably going to just continue to slow as that 200-day moving average catches up a little bit. And not that we'll touch it, right, but just that it catches up, right? So, we pull back or we slow down and go sideways while the blue line keeps moving higher. So keep that in mind. Again, you look at the Hakinyashi candles we look at on a weekly basis. You can see where the open is. Let's see where today's open so we can update the chart today. On SPY, we did get a small candle with an upper and lower shadow last week. So, that's a sign of weakness. Not a, it can be a reversal sign, but at least it's a sign of weakness that can lead to a reversal. And it has in the last few weeks. We've got 3 of them in the past 4 weeks. And then so far this week, we're doing okay with the open here at 290.50. We'll remember that number. If you look at the 3 green arrow charts for the S&P 500, we're back to 2 out of the 3. So we're still above a rising moving average. Again, hard to be too bearish when you're above a rising moving average. That means the average prices are just continuing to move higher. You can see, go back really quick to the Dow. Same thing, 2 out of the 3 green arrows. The NASDAQ has all 3 of the green arrows, not the Russell. The Russell has 3 red arrows. And in fact, if I were to take a look at the at the S&P 500 on the 2-line version, the MACD is grinding down. We moved up, but we're above the 8-day moving average, but we're still below the moving average. Stochastics also. Look at the Russell 2000. Look how different it looks. MACD below 0, below its moving average. Stochastics in the lower reversal zone, breaking down. The 8 and the 17 are below the 30-day moving average. It's rolling over. I mean, it's pretty bearish looking chart. And again, it's hard to be too bullish, strongly bullish, when you see this kind of pattern on the small cap index, which obviously has a lot more stocks than that S&P 500 index. All right, when you look at the 4-week chart, now remember, this includes that dividend. So while that dividend is still in the last 4 weeks, you have to take a look at the cash index because the cash index shows how bullish. I mean, look at that bullish open. We started off very strong up above last week's highs that quickly before reversing down into the lower half, or reversing down below last week's highs. Still, though, by the end of the day, despite the pullback, still not filling in the gap completely and still holding Friday's high for support, and actually bouncing off of that a little bit late in the session. So very, very late in the session. So you can kind of see higher high, higher low, closing above yesterday's high, but closing closer to the low than the high. And so that's not as bullish as it can be, right? Not as bullish. If we had started off down here and ended up here, different story. But again, usually the high of the day or the low of the day is really early in the day, usually. One or the other. And in this case, when you gap up so strong, you continue to move up early, it's not surprising when you see the high of the day be there, and then you move, or at least grind, even if it was just down to here, the rest of the day and finish closer to the low. And you can see it actually fell down even more. So that happens a lot when you get a big gap and you move in one direction, big gap, right? Then that's where it can set the high point. Now, if we were to start off here, with just a little gap, and it moves higher, then there's a better chance to go higher throughout the day. But when you start off so strong, again, it's hard, unless you're coming off of big time low points with high volatility, it's hard to maintain such strong bullishness throughout the rest of the day when basically you attract all the buyers early and then the rest of the day is all sellers. All right, let's take a quick look at the open here for the Hakinyashi really quick on the SPX. And we'll see here that it is today, this week's open is at 2908.57. So let's come over here. 2908.57, if I remember right. Yep, 2908.57. So we're going to change this to 2908.57. That is the Hakinyashi open. And we'll put this over here on the right. Well, we'll put it, on the right. So there it is. There's the Hakinyashi open in purple. It's a little bit above the midpoint of the 4-week range. And we're easily trading up above in the upper half of the range. So again, bullish. And this would be shaded green if we had shading on this one. You look at let's go back to SPY now. Here, let's go to this chart actually. Right here and pull up SPY. You can see a little bit above average range. Now keep in mind, SPY closed 290.72. Today's low was 290.98, so about a quarter point. So add on another quarter point. So it's above average on the range if you include the gap. 62 million shares trading. So when you look at it in context of the 52-week ranges, so two and a quarter points is right there. So it's a little bit above average, but still relatively low. 62 million shares trading is a little bit below the average, and of course, anything below 2.91 points on the ATR on the range is below that 1% mark. So we're not threatening the 1% mark. See, this is bearish territory. This is bullish territory. So we continue to grind away in bullish territory. And then finally look at the volatility index here, the VIX, and you can see how it's still gap down, still very low, even though it rose early in the day. We're really sideways, and of course on the relative chart, which is the more important one, we're again lower half of this bullish range, around this 85% mark. And this is the bullish range, this is the neutral range, and between the brown lines, this is the bearish range. So we are closer to the extreme lows on the bullish range. So to summarize, we maintain a bullish posture, but the cracks in the sidewalks are getting bigger. They're getting to be more frequent. There's a big one with that Russell 2000. So I'm not expecting us, even though this tends to be a bullish time of year, especially in the presidential cycle. This month, the next month, the month after that, the quarter after that, tends to be pretty darn bullish. Again, simply within the context of the presidential cycle. Regardless, I don't necessarily think we're going to get a long-term pullback anytime soon, but I do expect us to get more of an intermediate pullback like we're seeing on the Russell 2000, which will set us up for a better base to bounce off from, to maintain more healthy bullishness going into the end of the year. Whereas without a pullback, if we continued bullish into the end of the year, would be very unhealthy considering the lack of a pullback. And we've seen at the beginning of this year what happens if we go too long without a healthy pullback. We get a very unhealthy pullback, and it stings and hurts a little bit. So that's what I draw. That's the conclusion I draw from tonight's market forecast, market posturing routine. Do you agree with that? Do you disagree with that? Click the poll in the top right corner of your screen. Click that link. Then drop down into the poll. Click either agree or disagree. If you click on disagree, scroll down to the bottom. Type in the comment section. What are you seeing that either would suggest that I should be more bullish than I am, or that we are a lot more bearish than we are? Either way, comment down below with what you're seeing. Now let's take a look at what drove price action today. You can see the big mover on the day was crude oil. Crude oil up 3% today from the open. Remember, this intraday chart doesn't cover the gap from Friday's close. So from the open alone, crude oil up 3%. You can see up a little less than that from the close on Friday. You can see what some of these others, small cap stocks dropping pretty sharply here. But this wasn't a broad sell-off. While you did have gold and the dollar outpacing U.S. stocks, you also had U.S. Developed and emerging markets all pretty close to each other there, with a small loss to a small gain. If you take a look at SPX, up slightly here. Again, this is not this doesn't account for the gaps, right? So this is from the open today, a small loss from the open. You can see long-term bonds were down quite a bit. In fact, down even more than what you saw there because of the gap down at the open of the day. So real estate stocks, preferred stocks, these kind of alternatives types of stocks not doing so well. Of course, commodities really doing well in this breakout in crude oil prices. Same with the S&P 500, developed, emerging down here towards the bottom, underperforming ACWI, high yield outperforming investment grade. So this was not a sell-off type of a day, even though from a broad standpoint, mid-cap stocks down, small-cap stocks down. From a broad market standpoint, it was very focused on large cap stocks and dividend stocks. Other alternative stocks and small and mid caps all really declined, along with long-term bonds. So again, grain of salt in terms of how big of a risk aversion today was. If you take a look at crude oil, here we go. A little bit of a breakout move. We ended up with an overbought cluster today. In fact, Well, let's take a look at this one. Overbought cluster breaking out above those highs. So now let's take a look at the long-term view of crude oil. You can see the breakout that's occurring over really the last couple of weeks. A big breakout over multiple weeks highs last week. And then this so far, and again, one day only, right? But as of right now, getting above that evening star candlestick pattern. Very positive development for crude oil. If you were to change to say just 2 years, just get rid of that big drop that's scaling off the MACD. Again, you can see the MACD has room to run up to get as bullish as we've been already on this bullish run since really the summer of last year, where we've gone from $42 at a low point up to $75. So that's a pretty decent rally in crude oil price. You wouldn't know it driving through Wyoming right now. The gasoline prices are relatively low compared to where I get them anywhere else road tripping today. But still, that's a strong move. Commodity prices moving higher. We would expect that to eventually show up in the economic cycle when these commodity prices make a strong run relative to equity prices. Here's a ratio chart of commodities relative to stocks, U.S. stocks. And you can see commodities were lagging behind for a while here. Oops, let's try this one more time. Here we go. Here's a 3-year chart, a weekly chart. Again, remember, this is this week, so we're only one day into it. And you see how bullish last week was and how bearish, we've had a good bullish run early, but we've been really bearish on commodities relative to equities. And we have been really, again, since the end of 2015, it's made a pretty decent, here you can see the 5-year chart going all the way back to 14. Commodities have really underperformed, but they've been basing and starting to move higher. And when you get a move higher, that's a sign of late stages. Now, again, not late stages as in the bull market's ending next week or next month even for that matter. But, again, that's the signs of late stages. And we can get cycles within a big secular cycle. So we can rotate back to FANG stocks without a 50% drop in stock prices showing us a recession, right? We can cycle into it without a recession beginning. But we are starting to see cycling towards those commodity type stocks, materials and energy. You can see real estate and energy and materials led the way today, even though they're not quite moving up the chart yet. Energy is moving its way up and had a decent day today and is close to its 3-month highs, as crude oil is at its 3-month highs, obviously. Materials, though, on the other hand, it's still struggling, right? And it's had a really bad week and a half, down closer to its 3-month lows. So it's down here towards the bottom with financials, even staples. Look at staples, utilities, real estate, all below falling moving averages. So again, these are your safe haven areas. They're lagging, they're underperforming. Hard to be too bearish, right? That's why I expect an intermediate pullback. I don't expect a long-term pullback until these start to outperform more over a longer extended period of time. And you see industrials and technology start to move towards the bottom, and the new communication services sector also moving towards the bottom. You can see discretionary staples, consumer areas not doing as well. Big engulfing pattern today on the discretionary chart. But the bounce was in healthcare at new all-time highs, technology close to its 3-month highs, and industrials bouncing up back up off that moving average. And of course, energy. Those are your big bouncers today, and you can see that reflected over there. If you look at the 3-month returns, you've got strong returns. The S&P is at 8%. Healthcare and industrials have been, and technology have been the three that have outperformed the S&P. Everything else underperforming with the FANG stocks down and real estate stocks down over the 3-month period, and utilities pretty close to negative returns. So, and interest rates really hitting those areas pretty hard. And with yields rising, still trading up towards that, and up 0.8%, so up 2 basis points, getting back up to that 3%, and trying to maintain this breakout, right? This breakout move above 3%. You can see it's been hard to maintain that 3% breakout. We did get above 3%. We held it last week, and you can look at TLT, which has been trading down, getting down to this 115 level, very key important level for long-term bonds on this ETF. to hold for support. If it breaks that support, look for a jump higher in these long-term yields, which actually would not be, especially in here's the 30-year, which would not be a bad thing. It would be a reflection of growing economic growth expectations. As we saw the GDP for this quarter, the estimates for GDP jumping back up today to above 4%, so hitting 4.1% in economic growth and rate hike expectations also as a result rising back up to 50% for March for next year, that second rate hike. So the next rate hike's baking into the cake. It's the next one, which would be in March, that people are looking at. And after dropping closer to 40% after the FOMC meeting last week, now jumping right back up to 50%. All right, one stock I wanted to highlight in the growing and strengthening industrials area is CSX, breaking up above multiple weeks highs today. So you can see the close right about where my cursor is. You can see that horizontal line. You see all those highs that we close up above. Strong move. Not a lot of volume today, but you can see 3 green arrows here on this chart, on the 3 green arrow chart. When you look at it on the 2-line versions, you can see that we were really kind of, the MACD had dropped close to zero. We had moves higher. We had the moving averages had diverged away from each other. They've been converging, and instead of breaking out to the downside so far, we're breaking out to the upside with the MACD and stochastics up above their moving averages. You take a look at the long-term chart of CSX, and we've been really bullish for a long time. We are starting to bounce up a little bit here. We do have earnings coming out in the quarter here coming up pretty soon. You can see the earnings last year at this time of year sparked more of a pullback from these levels. You can look at the year before that. Here's the earnings the year before that, a little bit more of a pullback, not nearly as bullish those other 2 years, this particular quarter. Here's the earnings right here, same quarter a few years prior, and we were pretty relatively flat. And then finally, here's the earnings report in the same quarter, and we rallied up, which at the time was a pretty strong bullish posture. So big moves. We know here we moved higher. We were really strong, stronger than we were on the MACD. That usually leads to a divergence, and that's what we got. Slightly higher highs with some earnings to help fuel that second high point there coming off of this low. See, earnings help fuel the first one, and then it helped fuel the second one too. All right, here's the earnings fueling the first peak. Are we going to get earnings fueling a second peak as well coming up at the end of the quarter, especially in a strong industry? Now, a lot of that might be baking the cakes. We don't want to be too bullish, so we do want to take a look at. Let's take a really quick look at some of these other signs, some of these other indicators that we typically look at. You can see the directional positive index had been pretty bullish for a while, had pulled back, now bouncing back up again, and then again looking at the Bollinger Bands, another common indicator study set we look at here on the videos. And this has been a strong volume node. Will act as a strong support level as we bounce off of this, with the next area of support down here, at this, according to the volume here, at about 65. So a break below this level, and you've got a little bit of a ways to go to the downside. We are closing up. We have been tightened up on the bandwidth as low as it's been, and we are breaking out of the upper Bollinger Band. Typically can be a bullish sign. You can see here a similar breakout pattern coming out of that earnings up above the upper Bollinger Band. So again, you can do an easy vertical spread trade here with these Novembers. Doesn't mean we have to hold it that long, but we can sell and try to get as much of that 58-cent credit. You can see as it is with that earnings is a high probability. If you take a look at the volatility with the earnings coming up, right there in this week, October 19th week, you've got a 27 volatility, whereas back in the back months, you're in the mid-20s. So a little bit higher than average. So the market's not expecting too big of a move heading into that. If you take a look at the straddle the week before, and you're looking at about $1.70 move as it is just to get to October, that week, the week before this week, by the end of this week, we're looking at about $13.20. So you're adding about 50 cents to the next week just in time passing. So a dollar would be about $1.80. Closer to $1.90 there. And then if you look at the week of earnings, you're at 350. So the put and the call option looking at about $3.50. So you can see a lot of that's coming. About half of that's coming from the expected move in the stock just to next Friday, much less the earnings of this particular week. So not a big, and that extra $1.50 on a $75 stock is not that big of a percentage run. So the market's not expecting that big of a percentage move to come out of this earnings. Like we've seen before, you can see this earnings had a big jump. This earnings, I mean, these are much bigger than a $3 jump, right? So you had that move higher from 64 up to 69. Over here, you move from 56.5 to 61 after earnings. Over here, you went from 58 to 57.69 on that earnings. Well, excuse me, the earnings announcement here was on 116. So 116 is right there. You went from 59.25 to 58.25. So not as big of a move. And then this one on 1017, so not as obvious. There's 1017. You went from 52.84 up to 54.23, so about $1.50. So you can see there's been a couple of times where we had a big jump. There's been others where we got about the same type of move that the market is pricing in for for right now for this earnings coming up. So this spread opportunity allows us to trade that volatility, the higher volatility, because it is a negative volatility trade. So it allows us to trade that higher volatility and try to get to most of this return as much as possible, hopefully before the earnings, if we continue to bounce higher, and then you can take your gains out of that. And if the volatility does drop, this particular option, this strategy will benefit, you can see right here, from that drop in volatility across the board. So that wraps us up for today. The market maintains its bullishness, but again, there are just more and more signs creeping in that you should be expecting that intermediate pullback, if you're not already, to come sooner rather than later. And again, nothing more than that. And even with the expectations, there is definitely a sector rotation going on, and one that we can be able to take advantage of with how we trade. So I'd love to hear your thoughts now. Now is your turn to discuss with me what you're thinking or seeing. Any questions or comments on tonight's videos? Any questions or comment on anything I didn't discuss? Remember to put those in the Market Outlook forum with that link that popped out in that top right corner of your screen. Just click that I if you missed it, and that will take you to all the links that are associated with this video. So as always, thank you again for watching tonight. Remember to subscribe to our YouTube channel. Click the thumbs up icon down below, and also comment on the video. Follow me on Twitter for more content like this throughout the week now that I'm back from vacation. And remember also to join our Market Outlook community on Facebook, as well as our Market Scholars community on marketscholars.com. Have a great evening, everybody. We'll see you all tomorrow.